Welcome to Al Stocks. In this video, we're going to talk about Clover Health and exactly what the Federal Reserve just did. Please excuse the winds in the back. The microphone might pick it up. We're currently under a tornado watch, but regardless, the show must go on. Before we give you the data, I need to give you some tools to help you understand the data and break it down to layman's terms. You see, a lot of investors talk about the CPI data. And for people that don't know what that is, it's just the Consumer Price Index, more specifically, a basket of goods that consumers buy, such as chicken, bacon, coffee, just normal things that the American population buys, and it tracks their prices for economic decisions and movements. Economists like to analyze these components because they get down to the nitty-gritty, like the cereal and the coffee, the people that what they buy. The thing is, the Federal Reserve uses something called the PCE. Now, a lot of investors that are new to the market may not understand what that is, but I'm going to break it down to you very simple. The PCE, I would say, is a little bit more reliable. It takes data directly from the businesses and corporations and the GDP of the country, and it tracks how are the producers of goods functioning. Now, the best way to break this down to you guys is by an example. So the PCE tracks essentially, for example, if you have a business that makes jackets, right? We want to track specifically how much does it cost for the business to create a jacket. Furthermore, how much is the business selling the jacket to the supermarket? Now, what the CPI measures is how much is the supermarket charging the jacket to the consumer, hence the Consumer Price Index. So now that we know the difference between the PCE and the CPI, another parcelation that you need to know is what is the difference between the core PCE and the normal PCE. And the best way to explain it to you is the core PCE does not take a look at energy and food. The reason is these products tend to be volatile. In fact, crude oil and energy supplies are actually controlled majority by OPEC. 13 top countries. The ones at the top are Iraq, Iran, Venezuela, and Saudi Arabia. Two of them that we don't really have great relationship with, Iran and Venezuela. So sometimes we want to exclude them so we have a greater understanding of what's happening with our economy. Well, you might be asking yourself, why am I talking about this? Well, the take-home message is simple. We want to know how much cost is being passed on to the consumer. Now, I'm going to give you part of my investment thesis, so at the end, we'll wrap everything up in a nice bow tie and present it to you. The problem that we're having right now is that Taco Bell, McDonald's, and all these jobs in the food and hospitality sector, they're having a hard time finding workers. A lot of workers don't want to work the 9-to-5 grind being paid minimum wage anymore. Manager positions are paying $50,000 to $70,000. Teachers are quitting their jobs to work at Amazon factories. A lot of this stress is causing these businesses to start increasing wages. The problem is you get to a point where you increase wages so much that the consumers have so much money that are they really going to buy Taco Bell or McDonald's? You see, businesses can't do that. It's a double-edged sword. You can't not hire workers because then your business model would go into shambles because you can't process your sales. But at the same token, you can't artificially inflate the wages because then workers won't buy those said products. Like, for example, McDonald's, Taco Bell, and Chick-fil-A. They're going to go for more gourmet food. So it's going to hurt the economy. So what do businesses have left? Very simple. Artificial intelligence and automation. Just look at Jamba Juice. They're going to those robotic, automatic, self-serving smoothie bars where you don't really need a worker to do those things. That's where we're headed. So now let me explain to you this example. You have business A and you have business B. Business A is a smart business. It says, you know what? I'm about to be extinct if I don't change my business model. So it says, hold the line. Let me call Mr. Alex Karp. Yes, Mr. Alex Karp. Yes, I need your Palantir software or any other software like that does artificial intelligence. More specifically, I like Palantir. And I go, this is a Clover Health video, but there's some similarities here. So hold the thought. What this business does is it artificially inflates the intelligence of your workers. It turns all of their workers, let's say without a college education, to have a PhD behind their name, because that's the point of technology. It is to artificially inflate your intelligence, which is what we use and why we use computers. By doing this, you decrease costs and make more money and secure your profit line, your bottom line, your net income. But now let's talk about business B. Business B, let's say, does not move into the era of the fourth industrial revolution. Does not go into automation or artificial intelligence. Well, they can do two things. They can raise prices, but what are consumers going to do? They're not going to buy from you. They're going to go to business A. there's going to be some competition. Fine. Let's say business B says, you know what, that's fine. We will keep prices the same and we'll try to battle these business A people because overall this is unsustainable. Well, what do you think is going to happen? Investors like us are going to see a shrinkage in their bottom line, a decrease in their profit margins. Their net income will start decreasing. And would you look at that? Investors will no longer invest in that business. And then they're eliminated, just like Thanos with the slap of the gauntlet. All these businesses that you see that do not adopt artificial intelligence and utilize technology to help decrease costs and to scale, they're going to be bankrupt. They're going to be history. So now that we went over this example, I hope that you see where this is going. So now we're going to go ahead and we're going to analyze the data that the Federal Reserve just gave out. I'm going to put it at the top right here, and I'm going to guide you to all of the important things that you need to understand as an investor. So I want you to listen to exactly what I say. Go down to the bottom left of the table where it says the federal funds rate. Right under there, it says September projection. In 2021, you see the same number, 0.1 over 0.1. There's not going to be an interest rate hike. However, if you go to 2022, you're going to see 0.9 over 0.3. You divide that out very simply, it's 3 times. Simply put, we're going to see 3 interest rate hikes in 2022. Going further, in 2023, you take that number, it's approximately 2. So we're expected to see 2 interest rate hikes in 2023. Now in 2024, I want to call it 1 to 2, at least 1 interest rate hike by 2024. Now you might say, this is dangerous. Why aren't the markets reacting to this? We don't like rates. Well, there's something interesting here. Now I understand the word transitory has been basically gutted and retired by the Federal Reserve, but the data says something else. In fact, Jack Dorsey is like transitory. Well, Mr. Jack, the data's in the pudding here, which is probably why Cathie Wood invested into Twitter right after he quit. In any case, I want you to take specific analysis of the PCE inflation, not the core, just the PCE inflation. Now, I want you to take your eyes and go to where it says on the variables, the PCE inflation. We already talked about what that means. If you skipped over the video, make sure you go back and listen. So as you can see, the new projections are at the top where it says 5.3 in 2021, 2.6 in 2022, 2.3 in 2023, and 2.1 in 2024. What are you seeing? You're seeing it go down. You're seeing an inflection point. This, by definition, is transitory. I believe, Cathie Wood believes, anyone with a freaking frontal lobe should believe that inflation is transitory. Just like what the Fed said, Federal Chairman Jerome Powell, transitory means different things to different people. Well, from my analysis, and I'm not an advisor here, but this is transitory because check this out. The PCE inflation rate is 5.3, and then all of a sudden by 2022, it drops down to 2.6. That's like half. So I believe that by the end of 2022 and the start of 2023, the whole inflation scares are going to be gone. It's over. It's done. What's interesting here is that look at real GDP. We see that GDP is going to fall from 5.5 to 4.0. But if you look at GDP from the September projections, the fall was actually greater. So we're actually going to see a greater GDP increase because of the inventory pileup last week when I talked about the warnings regarding the CPI data and the Federal Reserve monetary policy update, which falls in line to why Nordstrom fell, the JWN stock, because their profit margins were decreasing, the same fundamental analysis that I was speaking about earlier. Now, the unemployment rate is fairly easy to understand. It's going to go down in 2022 and it's going to stabilize. Now, what's interesting here, the Federal Chairman Jerome Powell was asked, are you going to raise interest rates while you taper? And the answer was clearly no, because why would you help boost the economy and at the same time raise interest rates? So you know what that means? We are going to have a couple of months of a Santa Claus rally. January, February boost is going to be imminent. This is great for mid-cap stocks. Now you might be asking yourself, okay, so I understand this data. So what does this mean to me? And how is it going to impact my portfolio, et cetera, et cetera? Well, check this out. The debt ceiling bill was literally passed. That's it. It's done. The stock market doesn't have any uncertainty at the moment. It looks like the Omicron variant was a nothing burger. So it seems to me that the tides have settled down, minus the winds outside and the tornado watch. So now in the upper right corner, I'm going to be giving you my bull, bear, and base case scenarios for the Clover Health stock along with my price target and star rating. For the bull case, I see Clover Health at $96 with a base case at $62.62 and a bear case at $43. My price target is $40 with a 4-star rating. Now, for people that don't know how I got these, you should look at my intrinsic value calculation. What I do is I simply go 10 years into the future and I discount at a 10-15% discount rate using a 2 to 4% perpetuity growth model to analyze the stock in today's present value. And I keep doing that every 3 months. It's like sending off lasers and reflecting back data and information and bringing it back so I can coherently get a picture of where the company is or where it's going in 10 years and to see in today's date if it's undervalued. Now, let me just be clear and set the record. Chamath's not an idiot. You think I'm the only one who did a DCF calculation? This man's DCF is probably way more fancier than mine's. In fact, on the side note, I actually look up to him like a big brother. You know, being a first generation, you have this drive, this hunger, and wanting to conquer your version of the American dream. For your family, for your community, for your country. So in any case, if you want access to all these price targets, my exclusive daily briefings, and if you like my analysis, there's going to be a link down below to my private Discord channel and lessons. Now, if you made it this far, consider liking, subscribing, and turning on all notifications. Please comment down below what you think of the video and what you think of the analysis. In fact, let me know what your analysis is. That's all I have for you today, folks. I'll see you on the next one.